Howdy, folks. Welcome to Liberty Call. Today is Tuesday, April 30th, 2024. Hope you are having a fantastical day out there. It's a beautiful day here in Colorado. Sun's out. It's like 70 degrees. It is amazing. Ooh, but my top button here looked like a slob. Anyways, hope you're having a good day out there. As you can see, I trimmed up the chin mullet that was down to here. So my father told me last time I saw him a few weeks ago that I looked like looked scruffy was the word he used. So does it look better, Dad? Hope so. Anyways, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, likes, shares, subscribes, follows, press the notification bell. All righty, well, let's go ahead and jump into today's numbers. Dow Jones was down 1.49%, 570 points. Woo! Closed at 37,815. S&P 500 was down 1.57%, closed at 50.35. NASDAQ down 2.04%. Closed at 15,657. The VIX was up 6.68% today. It's at 1565. Canada was down 1.35%. Brazil down 1.12%. And Mexico down 1.9%. Headed over to Europe, Germany was down 1.08%. The UK down 0.04%. France down 0.99%. Let's see. The Netherlands down 0.39%. Spain down 2.22%. Italy down 1.6%. Switzerland down 0.63% and Portugal down, 0.97%. Russian exchanges both in the red today. The MOEX down 0.2%, the RTSI down 0.25%. And the Asian markets, the Nikkei in Japan was up 1.17%, Australia up 0.35%. New Zealand, nothing right now. In China, the Shanghai was down 0.26%. The Shenzhen Component down 0.9%. China A50 down 0.18%. DJ Shanghai down 0.43%. Hang Seng up 0.09%. And the Taiwan weighted when it closed on the 29th was up 1.86%. All righty. So looks like it was a pretty ugly day around most of the globe, except for, there are a few bright spots there in the Asian markets, but that is it. Shocking, I know. All righty, well, let's go ahead and jump on over to the market recap. S&P 500 snaps losses pile up in April. Ooh, that's not good. On Tuesday, the S&P 500 ended its 5-month winning streak, influenced by data revealing increased wage pressures that heightened concerns about inflation, particularly as the Federal Reserve commenced its two-day policy-setting meeting. The employment cost index for the first quarter exceeded expectations, with labor costs rising 1.2%, driven by higher wages and benefits. On a year-on-year basis, labor costs increased 4.2%, contributing to ongoing inflation worries, following recent reports of price pressures in the first quarter. The Federal Reserve is widely anticipated to maintain its benchmark interest rate between 5.25% and 5.5% range during this meeting, a stance held since last July. Market participants are keenly awaiting Fed Chair Jerome Powell's remarks following the policy statement for insights into the Fed's stance on future rate adjustments. And if you recall, just last week they were talking about maybe only one rate reduction this year. So it went from like 4 or 5 just a few months ago down to 1. And it may not even be till the end of the year. So for anyone out there hoping that interest rates are going to start dropping, now granted, we could have the economy and the stock market fall to pieces. That gives them a perfect reason to lower rates. So that will give them, in my opinion, that is going to be the window that they're going to use to lower rates. Not, the economy's fine and we're just going to start edging it down a little bit. All right. Investor sentiment has shifted away from expecting rate cuts in the near term, with September now viewed as the favored month for potential rate adjustments, according to the CME FedWatch tool. In corporate news, Eli Lilly, 3M, and Coca-Cola reported positive earnings outcomes, with Eli Lilly's stock rising 6% on strong performances from its diabetic drug and new weight loss treatment. 3M also exceeded analyst expectations, with plans to allocate approximately 40% of its adjusted free cash flow to dividends. Despite Coca-Cola's beat on earnings and revenue, its stock declined. McDonald's experienced a slip in its stock value after reporting weaker than expected Q1 earnings, with same-store sales falling short due to boycott calls amid the Middle East conflict. Other notable developments included Paramount Global CEO stepping down amid merger discussions, HSBC's stronger than expected Q1 profit announcement coinciding with its CEO's retirement, and PayPal's stock rising following better than anticipated first quarter total payment volume. Additionally, Bitcoin experienced a decline, dipping below 60,000, with losses exceeding 14% for the month, marking its largest monthly decline since November of 22. And remember, you don't lose anything with Bitcoin until you sell it. So if you're stacking coins, then it's probably not much of an issue. All righty, let's move over to the next article here. Growth in U.S. labor costs accelerates in the first quarter. In the first quarter, U.S. labor costs surged more than anticipated, driven by increases in wages and benefits, signaling continued inflationary pressure that could delay anticipated rate cuts later this year. The Employment Cost Index, a comprehensive measure of labor costs, rose by 1.2% in the first quarter, exceeding the 0.9% increase observed in the previous quarter. Year-on-year, labor costs climbed 4.2%, consistent with the same margins seen in the fourth quarter of the previous year. Despite recent easing in the labor market conditions, the upward trend in labor costs highlights persistent inflation concerns, particularly within sectors such as transportation, professional services, and wholesale trade. This data underscores the Federal Reserve's ongoing two-day policy meeting, during which the central bank is expected to maintain its benchmark interest rate at its current range between 5.25% and 5.5%, a level held since last summer. Fed Chair Jerome Powell's post-meeting remarks are closely monitored for indications on the Fed's stance on future rate adjustments, with market expectations for rate cuts shifting from June to September, according to the CME tool. The rising costs within the labor market coincide with broader inflationary pressures, as demonstrated by recent reports highlighting increased housing prices and overall consumer price pressures in the first quarter. Analysts caution that these trends could challenge the Fed's efforts to achieve its target of a 2% inflation rate. If I could pause there. I forget where I was listening to this yesterday afternoon, one of my podcasts that I frequent, and they were saying that their best estimate was that, there's some rumblings among the Fed governors that the best they're going to get to is 3% inflation, and we may be there for a number of years. So that's not good either. All right. Looking ahead, economists anticipate that the ongoing labor market dynamics, including rising immigration and potential shifts in worker productivity, could gradually mitigate wage pressures. Yeah, because if you bring in, illegals, they'll work for free or virtually nothing, and that helps bring price or labor costs down. Doesn't really help Americans, but is what it is. These adjustments are viewed as essential for aligning inflation closer to the Fed's target and supporting sustained economic growth. Additionally, reports from the Federal Housing Finance Agency revealed a rebound in house prices in February, underlining persistent challenges related to housing supply shortages, which further contribute to inflationary pressure in the economy. So it's not good. Inflation is real, real sticky, and until it goes away, which who knows when that's actually going to be, we're just going to have to deal with it. Last up comes from Zero Hedge. This article is titled "On the Verge of Panic, Dallas Fed Services Survey Suffers Longest Slump Since Lehman." And we know what happened to Lehman. The recent soft survey data paints a bleak picture for the U.S. economy, with the Dallas Fed Services survey reporting a significant drop from negative 5.5 to negative 10.6. This marks the 23rd consecutive month of contraction in the survey, reflecting ongoing challenges comparable to those seen during the collapse of Lehman Brothers. 2008. That was a good year. Looking forward, the survey indicates a troubling stagflationary environment characterized by slower revenue growth and faster price increases. General business activity is anticipated to decline for the first time since November of 23, reflecting growing economic concerns. Respondents from various sectors provide insight into the economic realities they face. Inflationary pressures are cited as a major issue, with rising costs squeezing profit margins, particularly in industries like truck repair and transportation. Moreover, uncertainty stemming from political and geopolitical factors is weighing heavily on business. The upcoming election year is amplifying concerns about economic direction and regulatory policies, contributing to decision-making delays and market volatility. Excessive regulation is identified as another hurdle, with businesses highlighting the burden of federal regulations on cost and operational efficiency. Shocking, I know. High interest rates, coupled with the Federal Reserve's stance on maintaining rates, are further dampening business outlooks, impacting investment decisions and deal-making activities. The sentiment within industries like construction and manufacturing reflects a sense of urgency and distress. Businesses report significant declines in activity, with some comparing current conditions to those experienced during the Great Recession. The real estate market is particularly worrisome, with indications that future construction may be hampered by zoning delays and reduced demand. demand. Overall, the commentary from respondents underscores the pervasive sense of uncertainty, caution, and economic strain across various sectors, reflecting broader concerns about the trajectory of the economy and the impact of policy decisions on business operations and growth prospects. Yeah, I think the housing real estate, residential real estate, I think it'll be fine. I mean, yeah, right now there's a shortage, as they say, of homes for people, but I see the commercial real estate is really the albatross around the neck of the overall real estate sector, just because, with the last 3 or 4 years where people are no longer working in offices, or a lot more people working from, virtual or remote, there's just not that need. And I mean, who really wants to drive 45 minutes downtown or wherever your office may be and, spend, an hour and a half in the car each way? It's just not a lot of fun. It's much more fun to, walk into your office in your house, sit down, work. Anyways. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. Right there on the screen. Like I said, all my contact information is there. If you need to reach me, feel free to do so. I hope everyone has a wonderful evening, and I shall talk to you again next time. And, while I'm still remembering, if you could, give me some thumbs up, likes, shares, subscribes, follows. And again, don't forget to press that notification bell. Hope everyone has a wonderful evening, and I'll talk to you next time. Adios.